Well, that does it. 2014 is in the books, and here are the closing numbers for the year. Keep in mind that these do not include the dividends. It's just appreciation of the actual index. The S&P 500 up 11.2%, Nasdaq up 17%, Russell 2000 3.6, semis had a great year up 28%, and oil down 42%. So gold was down a little bit this year as well again, and the dollar was strong, as were bonds. So let's take a look at the action on the charts here and see where we head into 2015. I don't have any grand plans for 2015 or any ideas, predictions, that is. Instead, we're going to continue to focus on the same things we always focus on, which are risk management and being objective about our analysis of the market. That's what I promised to you, is that in 2015, I'm going to do my best to remain as objective as possible and bring to you only information that I think will help make you money. The Russell 2000, let's just go back to that. I posted this chart earlier in the day. The 2014 for the Russell 2000, we ended up 3.9%. Look at all the time we spent underneath break even for the year, and more than half of the year was actually at a loss, but we finished with a gain. So, the end of the year doesn't mean anything. December 31st means nothing. It's just a calendar change. What we need to stay focused on is staying intact with or in tune rather, with the intermediate term trends, and knowing when to be involved and when to be more cautious. So the S&P 500, as we noted yesterday, was closing below that 5-day moving average. And I said that if we broke this low, then we have a lower high and a lower low below a declining 5-day moving average, which made the intermediate term guilty till proven innocent. So we sold off here today and remained below that volume weighted average price for most of the session here, closing close to the lows. But it's done nothing to damage the bigger trend on the daily chart. We're getting a pullback here to the 20-day moving average, and perhaps we pull back down to the 50-day moving average. We had a great rally here in October, and then a pullback of that. Now we're rallying again and pulling back here. So we remain a little bit volatile, and we're going to stay focused on the trends of the intermediate term. That's where swing traders and day traders have the best opportunity to align themselves with those trends so that they can make money each day, each week. And, no one makes money every single day, but if you're in tune with the trend of the market for the intermediate term trend, you're going to not make mistakes of buying because you think it's down too much, or buying because you think it's a support or whatever. You're going to be focused on buying because price action tells you to, and that again is going to be the focus of next year. It's no different than anything that I've been talking about for pretty much my entire career while I've been providing advice. That is, I didn't, these are everyone makes the same mistakes, and you learn not to fight the trends after losing a lot of money, and I've made those mistakes, as I'm sure most of you have. So we broke support. We're guilty till proven innocent on the intermediate term, and we'll look to see where this market in fact finds some support. The Nasdaq was down $1 today, so it broke some support here as well, of course, as it broke this 104 level. That's the area we had been focused on. We saw that we were briefly above that 5-day moving average, but then we saw the break of a lower low and then a lower high below that 5-day moving average, which is now declining. And we're going to be looking at 104 to 104.5 as our band of resistance that we're going to need to overcome in order to get positive on this market once again. So yesterday we were talking about being neutral. Now we're back to negative on the intermediate term. I'm not going to try to predict where it finds support. We can look at potential levels, and the 50-day moving average would be the first obvious level that the market has the potential to find buyers at. But again, it doesn't mean that we purchase there. It means we observe the action on shorter term time frames and look for actual evidence that the buyers are there. Russell 2000 lost 72 cents today, and this market had been behaving better than the rest of the markets, but did succumb to that pressure late in the day as it broke support over the last 3-4 days and made a lower low. And it is also below a flat to declining 5-day moving average. So we're now looking at 120.5 to 120.75 as our first important band of resistance that this market will remain guilty till proven innocent while we're below that, meaning that the primary trend, of course, is still higher here, but we're experiencing a pullback, and trying to buy pullbacks doesn't make any sense. Instead, we wait for the evidence that the buyers have regained control like we did over here. And right now, with it below the declining 5-day moving average, it's guilty till proven innocent. Semiconductors, same thing. We'd seen that this group had been the laggard here this past week. It looked like it was improving here this morning, but this market also found resistance at this prior support area and the declining 5-day moving average, and we're seeing lower highs and lower lows there as well. In the daily time frame, we could see a pullback again down towards this level, the prior resistance, which became support, or perhaps the 50-day moving average. Again, it's not trying to predict, it's trying to anticipate and then align ourselves with the trend once the actual evidence that the buyers have regained control. That's when we want to get long, not while it's still declining. There is no advantage to that. We say it over and over again, and there's still people who are still trying to buy stocks in downtrends, and you can just do so much better and have so much less stress if you wait for the selling to subside before getting involved again on the long side. The financials did break down as well. They had been holding up here, and we've been talking about the band of support 2480 to 2490. Well, we broke that level. And now in here on the intermediate term, we're going to need to get back above really 24.90 to 25 to become more neutral. Once again, we do have lower highs and lower lows going into next year. So, at the beginning of the year, my prediction is that this trend will continue until it doesn't continue, until we see evidence that the buyers actually are regaining control. And right now, it's stupid to try to find that support. Where we are right now might not be any different from being right here. Or it might be right here, or it might be ready to turn back higher again, but the evidence simply doesn't suggest that it's ready to turn higher. We're better off sitting on the sidelines in cash waiting for it to settle down, or to be scalping on the short side, but not to try to fight the trends. If you do anything different next year, I would say try not to fight trends. Manage risk better. Look objectively at the markets. I'm going to do my best to help guide you and just continue to show you that trading with the trend is the lower risk, higher probability, lower stress approach to making money consistently in the markets. It doesn't mean that you're not going to miss trades. There's no single strategy out there that's going to get you into every winning trade. And chasing trends is obviously one of the biggest mistakes that I talk about, that I see people making. We don't want to chase things. We want to look for those low risk, high probability setups. Apple, we'd spoken about the 5-day moving average had the potential to hold as support a couple days ago. That's where we had seen the 5-day moving average as well, but we didn't want to purchase there because it was still in declining mode, and we've broken lower highs and lower lows. We're below a declining 5-day moving average, and Apple is now guilty till proven innocent. 112 to 112 and a quarter is really our first band of resistance. That we remain below that and below a declining 5-day moving average. There's no reason to be making fresh purchases in Apple. If you're a longer term investor, it's up to you to decide where that where your cut point is. But right now, there's no reason to be involved in Apple if you've for going into next year if it's a fresher position, not while we're below that declining 5-day moving average. Let's take a look at some of these other bigger trends. Gold, of course, was down 2% as we had just noted. So we continue to see that we've got a declining 50, 100, 150, and 200-day moving average. That makes it very difficult for gold to try to move higher. We had seen, of course, we had spoken about the potential for a break down here, and from a failed move might come a fast move higher. We're not seeing that. We're seeing what gold does. It trades very choppy. It gaps almost every single day. This is why I don't trade it. I think it's a useless trading vehicle. If you're a longer term holder of gold, that's a different story. But we're still still longer term, neutralizing at best in here, still in a primary downtrend with it below those longer term moving averages. The US dollar had a great year, finishing right up at the highs for the year. You can see that 23.97 was that high. So, great uptrend here. A lot of people tried to pick the top and say that this was the end of the move or one little gap lower. You've got to stop responding so emotionally to a little reaction within a primary trend. Oil is a great example of that. Oil was down further again today. Let me just get to that chart. If we take a look at what I'm going to pull up here is a 4-hour chart. So each candle here represents 4 hours, and for some reason my scaling isn't working properly. Let me just get this focused. So we had seen that this was that descending triangle that we had broken, and we continue to be lower highs and lower lows. I think 54.50 at a minimum is going to be needed to be taken out before we can think that this market has the opportunity to rally once again. A big decline like this doesn't simply reverse all at once because of a king who's in bad health. It takes a lot more to reverse a trend. Bonds had a great year, obviously. They remain still in a primary uptrend. We had seen a little dip below the 5-day moving average earlier, and now we're back above it once again. So, when we have the primary uptrend and then we see that these periods where we pull back, those are cautionary periods and periods where you scalp to the short side. And same thing goes true, of course, for the Nasdaq, for the S&P, and all these markets, that we still have primary uptrends. We can't get freaked out about 1 or 2 days or 1 or 2 weeks of a pullback. It takes a lot to reverse a huge uptrend like this, where we've seen 6 years of higher highs and higher lows in these markets. So that's all I'm going to talk about for today. We'll get more involved in it on Friday, and I will be updating those January effect stocks as well here in the next day or two. Hope that it was a great year for you in 2014. If not, I would encourage you to look at yourself and say, what is the issue? You weren't unlucky in the market. There's no such thing as the luck being the factor in the market. If you're properly diversified and you that is position size properly, you can overcome the occasional surprise gap lower where you get hurt overnight. But if you're looking for consistency, then it's up to you and your execution of a strategy that works well for your mentality. For me, it's trend trading. Hopefully that's the way it is for you as well. I can't tell you what to do. I can lead you and coach you. That's my job. It's not to tell you what to do, but to provoke you to think and to see things for yourself in the market so that you can be self-sufficient. So I hope it was a great year in 2014, and that next year we'll do our best to make it an even better year. Have a safe holiday, and I will talk to you again on Friday. Thanks.